For decades, central banks were viewed as omnipotent. When markets faltered, they intervened. When growth slowed, they eased. When crises emerged, they stabilized. This pattern repeated so consistently that it became assumed. Markets stopped pricing risk independently. They began pricing central bank responses. This dependency created an illusion, the illusion that policy could always prevent severe outcomes, that interest rates could always be lowered, that liquidity could always be injected, that balance sheets could always expand. But every system has limits, and central banks are now approaching theirs. This is not a statement about competence. It is a statement about constraints. Constraints imposed by inflation, constraints imposed by debt, constraints imposed by political pressure. When central banks operated with unlimited flexibility, markets functioned differently. Risk was transferred to policymakers. Downside was absorbed by intervention. Confidence remained high because support was guaranteed. That framework no longer holds. The conditions that allowed aggressive easing have changed. Inflation is no longer dormant. Debt levels are no longer manageable through rate suppression alone. Political tolerance for unorthodox measures has declined. This shift is structural. It changes how markets must adapt. For most of the past 15 years, central bank policy followed a predictable pattern. When growth weakened, rates were cut. When markets wobbled, liquidity was provided. When inflation remained subdued, intervention carried few costs. This created a one-directional bias. Policy responded to weakness, but rarely tightened preemptively. Over time, this asymmetry distorted behavior. Investors stopped hedging tail risk. Corporations leveraged balance sheets aggressively. Governments postponed fiscal discipline. All relied on the assumption that central banks would continue absorbing downside. That assumption was reinforced repeatedly. In 2008, unprecedented intervention prevented collapse. In 2020, even more aggressive measures stabilized markets within weeks. Each success validated the framework. Each validation encouraged greater risk-taking. But dependence on intervention has a cost. It reduces system resilience. When participants assume protection, they take positions they would not otherwise take. When those positions concentrate, the system becomes fragile. Central banks are aware of this dynamic. They understand that prolonged accommodation creates imbalances, but they face a dilemma. Tightening policy risks, triggering the instability they are meant to prevent. Maintaining accommodation risks inflating the imbalances further. This dilemma has no clean solution. It forces choices between competing objectives. Historically, central banks prioritized inflation control and financial stability. These goals were compatible when inflation remained low and financial conditions remained stable. Today, they conflict. Inflation requires restrictive policy. Financial stability, given elevated debt and leverage, requires accommodative policy. This tension is unprecedented in modern experience. It limits the effectiveness of traditional tools. Interest rates are the primary tool of monetary policy. Lowering rates stimulates borrowing and spending. Raising rates slows inflation but tightens financial conditions. For decades, this mechanism worked reliably, but its effectiveness depends on context. When debt levels are low, rate changes influence behavior smoothly. When debt levels are high, rate changes have nonlinear effects. Small increases can trigger significant stress. This is where central banks now find themselves. Rates cannot rise much without destabilizing leverage positions. Rates cannot fall much further without reigniting inflation. This narrow range constrains policy flexibility. It forces central banks to operate within boundaries that were not present in previous cycles. Another constraint is balance. Sheet size. Quantitative easing expanded central bank balance sheets dramatically. Assets were purchased to inject liquidity and suppress long-term rates. This worked during crises. But balance sheets cannot expand indefinitely. At some point, the costs exceed the benefits. Those costs include inflation risk, market distortion, and political backlash. Central banks have begun acknowledging these limits. Quantitative tightening has started. Balance sheets are shrinking, but this process is slow and sensitive. Reducing balance sheets too quickly removes liquidity and destabilizes markets. Reducing them too slowly prolongs distortions. There is no neutral path. Forward guidance is another tool that has lost effectiveness. Central banks communicate future policy intentions to shape expectations. This worked when credibility was high and conditions were predictable. Today, credibility has weakened. Markets no longer fully trust forward guidance because conditions change faster than projections. Inflation surprised central banks. Rate paths shifted repeatedly. Guidance was revised frequently. Each revision reduces trust in future guidance. This makes communication less powerful as a tool. Another constraint is political pressure. Central banks were designed to operate independently. Independence protected them from short-term political influence, but prolonged intervention has made them more visible and more controversial. Critics argue that central bank policies benefit asset owners disproportionately. Others argue that intervention enables fiscal irresponsibility. This scrutiny increases pressure. Politicians demand accountability. Populations question fairness. Central banks must now balance technical objectives with political sustainability. This is a new constraint. It limits the scope of action. The erosion of policy space is gradual but cumulative. Each tool becomes slightly less effective. Each intervention creates slightly more distortion. Each constraint becomes slightly more binding. Individually, these changes are manageable. Collectively, they represent a structural shift. Central banks are moving from a position of dominance to one of constraint. This matters enormously for markets because markets have been conditioned to expect intervention. When intervention becomes constrained, market behavior must adjust. That adjustment is not smooth. It involves repricing risk. It involves accepting volatility. It involves recognizing that downside protection is no longer guaranteed. This transition is underway, not announced, not obvious, but structural. The most significant constraint facing central banks is the return of inflation. For decades, inflation remained low and stable. This allowed central banks to ease aggressively during downturns without consequence. Rate cuts did not trigger inflation. Balance sheet expansion did not trigger inflation. Massive fiscal deficits did not trigger inflation. This created complacency. Policymakers assumed inflation was structurally contained. Demographics, globalization, and technology were cited as permanent disinflationary forces. Those assumptions proved incorrect. Inflation returned with intensity not seen in 40 years. This fundamentally changed the policy landscape. When inflation is low, central banks face one primary risk: deflation and economic weakness. Policy errs on the side of accommodation. When inflation is elevated, central banks face competing risks. Inflation on one side, financial instability on the other. There is no direction that eliminates both. Tightening to control inflation pressures leverage systems. Easing to support growth accelerates inflation. This is the trap. History shows that once inflation becomes embedded, removing it requires sustained restrictive policy. Restrictive policy means higher rates for longer. Higher rates for longer means stress on debt servicing. And debt levels today are unprecedented. Government debt exceeds peacetime records. Corporate debt remains elevated despite recent deleveraging. Household debt, while lower than pre-crisis peaks, is still significant. All of this debt was accumulated, assuming rates would remain low indefinitely. That assumption is no longer valid. As rates rise, servicing costs increase. For governments, higher rates mean larger deficits unless spending is cut. For corporations, higher rates mean reduced profitability and investment. For households, higher rates mean reduced consumption and increased defaults. Central banks understand these dynamics. They know that aggressive tightening risks triggering recession or financial stress, but they also know that failing to control inflation undermines credibility. Once credibility is lost, inflation expectations become unanchored. Unanchored expectations make inflation persistent. Persistent inflation requires even more aggressive tightening. This creates a worse outcome. So central banks are forced to tighten even when conditions are fragile. They must prioritize inflation control over financial stability. This represents a reversal of the past 15 years. During that period, financial stability took precedence. Inflation was assumed manageable. Now inflation takes precedence. Financial stability becomes secondary. This shift creates vulnerability. Another constraint is the effectiveness of quantitative easing. QE was the tool of choice during the financial crisis and pandemic. It worked by purchasing assets, injecting liquidity, and lowering long-term rates. Markets rallied. Credit spreads tightened. Confidence returned. But QE has limits. The first limit is inflation. When inflation is low, QE carries few costs. When inflation is elevated, QE becomes counterproductive. Adding liquidity when prices are already rising accelerates inflation. This is why central banks have shifted to quantitative tightening. They are removing liquidity rather than adding it, but QT creates its own problems. Removing liquidity tightens financial conditions. It raises rates, it widens spreads, it reduces market depth. This is intentional, but it also increases fragility. Markets that became dependent on QE struggle when it reverses. The second limit of QE is market distortion. When central banks purchase assets, they influence prices directly. Bond yields are suppressed. Equity valuations are inflated. Risk premiums are compressed. This distorts price discovery. Prices no longer reflect underlying fundamentals. They reflect central bank intervention. Over time, this creates misallocation. Capital flows to assets that are expensive rather than productive. This reduces long-term growth potential. The third limit is political acceptability. QE disproportionately benefits asset owners. Those who own stocks and bonds see wealth increase. Those who do not see no benefit. This creates inequality. Politicians and populations have become more sensitive to this dynamic. Central banks face criticism that they're widening wealth gaps. This limits willingness to deploy QE aggressively in future crises. Another constraint is the zero lower bound. Interest rates cannot fall below zero without creating distortions. Some central banks experimented with negative rates. Results were mixed at best. Negative rates penalize savers. They compress bank profitability. They distort currency markets. Most importantly, they did not stimulate growth as intended. This means that when rates approach zero, monetary policy loses effectiveness. Central banks must rely on unconventional tools, but unconventional tools have diminishing returns. Each use creates distortions. Each distortion limits future effectiveness. This is why policy space has narrowed. Forward guidance, once powerful, has also weakened. Central banks communicate intentions to shape expectations. This worked when projections were reliable, but recent years have shown that projections are frequently incorrect. Inflation was called transitory. It was not. Rate paths were projected as gradual. They were not. Each incorrect projection damages credibility. Damaged credibility reduces the power of future guidance. Markets stop believing what central banks say. They focus on what central banks do. This makes communication less effective as a tool. Another emerging constraint is fiscal dominance. Governments have accumulated massive debts. Servicing those debts becomes difficult when rates are high. This creates pressure on central banks to keep rates low. Fiscal dominance occurs when monetary policy is subordinated to fiscal needs. Central banks ease not because it is optimal for inflation or growth. They ease because governments need lower borrowing costs. This was not a concern when debt levels were manageable. Today, debt levels make fiscal dominance a real risk. If central banks prioritize debt sustainability over inflation control, credibility collapses. If they prioritize inflation control, governments face fiscal crisis. This is another impossible choice. Coordination between fiscal and monetary policy is often cited as a solution. But coordination is difficult in practice. Governments respond to political incentives. Central banks respond to economic conditions. These incentives rarely align. During crises, coordination improves temporarily, but during normal times, it deteriorates. This makes sustained cooperation unlikely. Central banks are also constrained by global interdependence. Policy in one region affects conditions in others. When major central banks tighten, capital flows shift. Emerging markets face pressure. Currency volatility increases. Financial conditions tighten globally. This creates spillovers. Central banks must consider international effects, but they are mandated to prioritize domestic objectives. This creates tension. Aggressive tightening by one central bank can destabilize others. Yet each central bank must respond to its own conditions. This lack of coordination amplifies volatility. Another constraint is the speed of policy transmission. Monetary policy works with lags. Rate changes take months to affect the economy. This makes timing difficult. By the time policy effects are visible, conditions may have changed. This lag creates risk of over-tightening or under-tightening. Over-tightening triggers unnecessary recession. Under-tightening allows inflation to persist. Both outcomes are costly. Central banks must make decisions based on incomplete information. This increases error risk. The erosion of policy tools is not uniform. Some central banks have more space than others. Those with lower debt and lower inflation retain flexibility. Those with higher debt and higher inflation are more constrained. This divergence creates instability. Markets move capital toward less constrained regions. This amplifies pressure on constrained central banks. The most important realization is that central banks cannot eliminate cycles. They can smooth them. They can delay them, but they cannot eliminate them. Prolonged intervention delays adjustments. Delayed adjustments accumulate. When adjustments finally occur, they are more severe. This is the cost of intervention. Central banks now face the consequences of past actions. Years of accommodation created imbalances. Those imbalances cannot be unwound without pain. Attempting to avoid pain only increases it. This is why policy options are limited, not because central banks lack intelligence, but because the system has reached structural limits. Understanding the constraints facing central banks requires examining what policy actually achieves. Central banks do not create wealth. They influence its distribution and timing. When they ease policy, they pull future demand into the present. When they tighten policy, they push present demand into the future. This is not creation, it is reallocation. For decades, this reallocation appeared costless. Growth continued, markets rose, crises were contained. But reallocation always has consequences. Those consequences were delayed, not eliminated. Today they are materializing. One consequence is the erosion of productive investment. When rates are suppressed artificially, capital flows to financial assets rather than productive uses. Buybacks increase, dividends rise, speculation intensifies, real investment in equipment, technology, and infrastructure lags. This reduces long-term growth potential. Lower growth potential means lower future income. Lower future income makes existing debt harder to service. This creates a feedback loop. Central banks ease to support growth. Easing distorts capital allocation. Distorted allocation reduces future growth. Lower future growth requires more easing. The cycle reinforces itself. Another consequence is the loss of market discipline. Markets are supposed to allocate capital efficiently. Prices should reflect risk and value. When central banks intervene continuously, prices reflect policy instead. This breaks the feedback mechanism. Bad investments are not punished. Good investments are not rewarded differentially. Capital misallocation persists. Over time, this reduces system efficiency. Productivity growth slows. Innovation declines. Zombie companies survive. These effects are structural. They cannot be reversed quickly. Central banks are also constrained by financial stability mandates. These mandates expanded after the financial crisis. Central banks became responsible not just for inflation and growth, they became responsible for preventing financial instability. This expanded mandate creates conflicts. Controlling inflation may require tightening. Preventing instability may require easing. When both mandates are active simultaneously, policy is paralyzed. This is the current situation. Inflation remains above target in most regions. Financial conditions are tightening. Central banks cannot ease without abandoning inflation targets. They cannot tighten without risking instability. They are trapped between mandates. Another structural issue is the accumulation of non-performing tools. Central banks experimented with many unconventional policies: negative rates, yield curve control, credit easing, funding for lending schemes. Some worked temporarily, most created distortions, none became permanent solutions. Each experiment left residual effects. Markets became conditioned to expect innovation. When innovation fails, confidence erodes. Central banks are running out of new tools. They have exhausted conventional options. They have tested unconventional options. What remains? More extreme versions of past policies. But more extreme policies create more extreme distortions. This is diminishing returns. Political constraints are also intensifying. Central bank independence was once sacrosanct. Today it is openly questioned. Politicians criticize policy decisions. Populations protest inequality. Media scrutinizes every action. This environment makes bold action difficult. Central banks must justify policies publicly. Justification slows response. It creates caution. Caution is appropriate in many contexts, but in crises, speed matters. The need for political acceptance reduces effectiveness. Another constraint is institutional knowledge. Current central bankers have limited experience with high inflation. Most careers were built during the Great Moderation. Inflation was low. Volatility was contained. Policy was successful. This created assumptions. Assumptions about what works. Assumptions about what is possible. Those assumptions are being tested. Experience matters in policy making. The generation that managed inflation in the 1970s and 1980s has retired. Current leadership must learn through trial and error. Trial and error is costly. Markets are also evolving in ways that limit central bank influence. Decentralized finance is growing. Cryptocurrencies operate outside traditional systems. Shadow banking has expanded. These sectors are less responsive to traditional policy tools. Rate changes affect them differently. Liquidity provision reaches them indirectly. As these sectors grow, central bank influence declines. This is structural erosion of power. Another challenge is the speed of modern markets. Algorithmic trading dominates. High-frequency systems respond in milliseconds. Central bank policy works on a monthly or quarterly time frame. This mismatch creates instability. Fast markets react before slow policy adjusts. Overshooting becomes common. Volatility increases. Central banks cannot keep pace with market speed. This reduces control. Climate change is also emerging as a constraint. Physical risks and transition risks affect the economy. Central banks are being asked to incorporate climate considerations into policy. This complicates decision-making. Climate objectives may conflict with inflation or growth objectives. Central banks lack tools to address climate directly, yet they face pressure to act. This further divides attention and resources. Demographic shifts present another constraint. Aging populations change economic dynamics. Savings rates increase. Investment opportunities decline. Growth potential falls. These are structural forces. Monetary policy cannot reverse them. Yet central banks must operate within these constraints. Lower potential growth means less room for error. Mistakes become more costly. Geopolitical fragmentation is also limiting policy effectiveness. Global cooperation has declined. Trade barriers are rising. Supply chains are fragmenting. Political tensions are intensifying. This reduces policy coordination. It increases the risk of conflicts. Currency wars become more likely. Each central bank acts in self-interest. This amplifies volatility globally. Technology is also creating new challenges. Digital currencies threaten traditional banking. Central bank digital currencies are being explored, but implementation is complex. It raises questions about privacy, control, and financial stability. These questions have no easy answers, yet central banks must navigate them. The erosion of policy space is not a temporary condition. It is structural. Multiple constraints are binding simultaneously. Inflation limits easing, debt limits tightening, politics limits innovation, markets limit control. Each constraint reinforces others. Central banks operate within a narrowing corridor. This changes market dynamics fundamentally. Markets can no longer assume that policy will always support prices. Protection is conditional. Conditional on inflation remaining low, conditional on financial stability being maintained, conditional on political support continuing. These conditions are not guaranteed. When they fail, policy becomes constrained. When policy becomes constrained, markets must self-correct. Self-correction is volatile. It involves repricing. It involves deleveraging. It involves adjustment. These processes are underway, not announced, not obvious, but structural. What happens when central banks run out of options is not unknowable. History provides examples. Japan spent decades constrained by deflation, debt, and demographics. Monetary policy remained accommodative continuously. Growth stagnated. Europe faced similar constraints after the sovereign debt crisis. Policy remained restrictive to maintain currency stability. Growth underperformed. These examples show that constrained central banks produce constrained outcomes. Markets adjust by accepting lower growth, higher volatility, and reduced support. This is not catastrophic, but it is different. The current environment is evolving toward this reality. Central banks are communicating more cautiously. They emphasize limitations. They acknowledge uncertainty. They warn about trade-offs. This language reflects constrained capacity. Markets are beginning to recognize this. Risk premiums are adjusting. Volatility is rising. Correlations are shifting. These are signs of adaptation. Not panic, adaptation. The transition will be uneven. Some markets will adjust quickly, others will resist. Resistance creates instability, but eventually reality asserts itself. Central banks cannot provide unlimited support. Once this is accepted, behavior changes, leverage declines, risk management improves, expectations moderate. These are healthy adjustments. They restore balance. The process is uncomfortable. It involves losses. It involves repricing. It involves accepting that protection is not guaranteed, but discomfort is temporary. Balance is necessary. Central banks understand this. They are navigating impossible trade-offs: inflation versus stability, growth versus credibility, independence versus accountability. No path is clean. Every choice involves costs. The most important realization is that central banks are not omnipotent. They never were. The appearance of omnipotence was created by favorable conditions. Low inflation, low debt, political support. Those conditions no longer exist. This does not mean failure. It means constraint. Constrained central banks can still function. They can still stabilize during crises. They can still communicate effectively, but they cannot prevent all outcomes. They cannot eliminate cycles. They cannot guarantee growth. Markets must adapt to this reality. Adaptation involves recognizing limits, limits of policy, limits of intervention, limits of protection. Once limits are recognized, behavior becomes more prudent. Prudence reduces fragility. This is how systems restore resilience, not through intervention, through acceptance. Acceptance that downside exists, acceptance that risk must be managed independently, acceptance that no authority can eliminate uncertainty. This transition is gradual. It unfolds through small adjustments. Each adjustment shifts expectations slightly. Eventually, a new equilibrium forms. That equilibrium will be less dependent on policy support. It will be more resilient to shocks. It will be more sustainable. But reaching it requires transition. Transition is underway. Central banks are running out of options. Not immediately, not catastrophically, but structurally. Markets are beginning to understand this. Understanding creates adjustment. Adjustment creates instability temporarily. But instability is not collapse. It is recalibration. The system is recalibrating expectations. Expectations about growth, expectations about volatility, expectations about support. This recalibration is necessary. It restores realism. Realism is the foundation of stability. Not intervention, realism. Central banks are constrained. That constraint is not weakness. It is recognition of limits. Recognition of limits forces discipline. Discipline creates sustainability. The transition is difficult, but it is necessary. And it is happening, quietly, structurally, inevitably.